Google just reported earnings and the stock is down over 4.5% in the after hours. I think it's an absolute joke of a price action because the company put up good numbers, yet the stock is still down 4.5%. Massive overreaction. I'm going to talk about why the stock is going down here in the video, discuss earnings and look at them in general, and also give you an update on my own valuation model to try to determine a fair price we can potentially buy Google at. Now, looking at the Google chart, it's been performing pretty well in 2023, but the stock has been pretty much flat for 2 years. I mean, it's still sitting at the same price it was sitting at in 2021. It's the same thing for the S&P. The S&P has been flat for 2 years, even though it doesn't feel this way because a lot of stocks have been rallying so much, but they did go down a lot in 2022, and it was an amazing buying opportunity in Google that I took advantage of, and many other people actually did, but the stock has been pretty much flat for 2 years. Now, in terms of the earnings themselves, they put up a pretty good beat on EPS, $1.55 versus $1.45 expected. Pretty amazing. They also beat on revenues, 76 billion versus something 75.9. I mean, also pretty amazing. But why is the stock going down? It's mainly because of the Google Cloud revenues that came like $20 million below expectations. I mean, absolutely insane. YouTube advertising revenue, they beat on everything except the Google Cloud, and the market just ignoring all the numbers and they just focus on Google Cloud, which is pretty funny to me. And it came at 8.41 versus 8.64, around a $20 million miss, I believe, something like that. It's nothing, nothing too crazy. And if you look at, the cloud itself, I mean, it has been growing. I mean, the revenue has been growing. Now it's over 11%, market share in terms of, cloud, in terms of global market share. Amazon is first at 32%. You have Microsoft Azure, it's around 22%. And you have Google Cloud at 11%. Google has been catching up. But the market mainly wants to see profitability. And Google Cloud has been growing pretty quickly, but it's not as profitable as the market actually wants. And if you look at, what the analysts are saying on CNBC, which is pretty funny again, they said, if you want this stock to keep going higher, you've got to have, cloud become more profitable. And I kind of agree, but cloud is not the only thing with Google. I mean, Google is much bigger than that. They have so many businesses. The ad business is booming. YouTube has a wide moat, and TikTok is not affecting YouTube. A lot of people said that. Not at all. It's a totally different thing. And Google, is still thriving. YouTube is still thriving, and many of their other businesses, and Android and stuff. So I don't know why. I mean, the analysts are so focused on Google Cloud, and Google Cloud's profitability has been, getting a little bit better. Like, it used to lose money in 2022. Now it made $226 million in operating income. It's not the best at all. And a lot of people claim that maybe they're just putting up the cost in terms of corporate cost, because the corporate cost was $83 million and it jumped to 1.6. So a lot of people believe that they took the loss out of Google Cloud and they just put it up in something like the corporate cost to make it look like Google Cloud is profitable. And this is very possible, and it's hard to prove otherwise. But I personally believe that the profitability in Google Cloud is getting better. That revenue is still growing like 22% for Google Cloud, and it's getting better in general. But I think it's pretty ridiculous for the market to ignore all those beats and everything, pretty much the EPS, the revenue, YouTube ad, other kind of businesses that are doing well, and just focus on Google Cloud and sell off the stock 5%. But this is just what happened, and this is why the stock, has been coming down. Google still has an amazing balance sheet, $119 billion of cash, pretty amazing balance sheet. Just think about it. If they could put them in short-term treasuries, they would collect maybe 6 or 7 billion in interest. This is why these stocks have been doing so well, the Magnificent Seven. They have such amazing balance sheets, while you have other stocks in the Dow that have such high debt and they're not benefiting from higher interest rates. They're getting killed from higher interest rates. And this is why we had the Magnificent Seven outperformance. I made a video on it and I talked about it a little bit more. Google is still buying back a lot of stock every single quarter since 2020. Before that, the shares outstanding were pretty much flat to going up. But since 2020, the company has been buying back stock. And as you could see in this chart, every single quarter, Google keeps buying back stock around 2.5% of the market cap. Sometimes it's around 1.5%, but it's still, pretty good, especially in 2022. They took advantage of ridiculously low prices, and I believe they did, pretty good on that. And if I look at my own valuation model on Google to determine a fair value on the company, I put up $304 billion for current revenues. I put in 10% for 2023 to 2027. I believe 10% every single year is a pretty fair number for Google. I would not bet on anything higher than 10%. I think 10% is fair. Net income margin, 24%. I left it at 24%, but if Google Cloud becomes more profitable in the future, then the net income margin could be maybe 27 to 28%. But I'm not betting on that. I always bet on the worst case scenario to the base case scenario. So I'm using 24%. I believe it's fair. For a PE ratio, I'm using 22 times earnings. If you look at at the forward PE ratio right now, it's around 22. So I'm using the same thing, even though it's much lower than what it used to trade at before, around 29 to 30 times earnings. It's possible that Google could go back over there, but this is not a scenario I want to bet on. So I think 22 times earnings is also fair, and a 1.5% buyback yield, which I put it in the dividend category. With these numbers, I'm now getting around 60% on the upside, or 9.8% CAGR for the next 5 years, which is actually not bad at all. But if I want to double my money with Google over the next 5 years with the case scenarios that I have, which is the base case, not the best case, it's some base case to worst case scenario, I would have to buy Google around 107.71. So 107 would be, something where it was, just a few months ago in May. And I'm not sure if Google is going back there. It's pretty possible. The stock right now is still going down. Now it's 5.7%, absolutely ridiculous. But 107 would be an amazing buying opportunity for Google, or something close to 110 or below. I think we can get over a 15% CAGR every single year, or something like a double over the next 5 years. It would be amazing. Google is still my favorite mega cap stock. I much rather own Google than the other one. Google and Amazon, I think they're pretty good. Meta is good also. It had a huge run. But this was my opinion on Google. It was not financial advice. Thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.